What is financial risk management? Financial risk management is the process of identifying and addressing financial risks that your business may face in the present or future. It is not about avoiding risks, as few businesses can operate in a risk-free environment. Rather than that, it is a matter of drawing a line in the sand. The objective is to determine which risks you are willing to take, which risks you would prefer to avoid, and how you will develop a strategy based on your risk tolerance. The action plan is critical to any financial risk management strategy. These are the practices, policies, and procedures that your business will follow to ensure that it does not take on more risk than it can handle. In other words, the plan will communicate to staff what they can and cannot do, which decisions require escalated authority, and who bears overall responsibility for any risk that may arise. How do you manage financial risk? Financial risk is managed differently by different organizations. This process is dependent on the nature of the business, the market in which it operates, and the level of risk it is willing to accept. In this sense, the business owner and directors of the company are responsible for identifying and assessing risks and determining how the company will manage them. The first step in risk management begins with the identification of financial risks and their sources or sources of origin. A good place to start is with the balance sheet of the business. This section summarizes the company's debt, liquidity, foreign exchange exposure, interest rate risk, and commodity price vulnerability. Additionally, you should examine the income statement and cash flow statement to determine how the organization's income and cash flows fluctuate over time and the effect this has on the risk profile of the organization. Among the pertinent questions to address here are the following. What are the primary revenue streams of the business? To whom does the business extend credit? What are those customers' credit terms? What kind of debt does the business owe? Is it a short-term or a long-term strategy? What would occur if interest rates increased? The second step is to quantify or assign a numerical value to the identified risks. Naturally, risk is uncertain, and quantifying risk exposure will never be precise. Analysts frequently employ statistical models such as the standard deviation and regression to determine a business's exposure to various risk factors. These tools calculate the difference between your data points and the average or mean. For small businesses, computer software such as Excel can aid in the efficient and accurate execution of some straightforward analysis. As a general rule, the larger the standard deviation, the higher the risk associated with the data point or cash flow being quantified. Choosing a hedging strategy. After analyzing the risk factors, you must decide how you will respond to this information. Are you prepared to live with the risk exposure? Do you need to mitigate it or protect yourself in any way? This decision is based on a number of factors, including the company's objectives, its business environment, its risk tolerance, and whether the cost of risk mitigation justifies the risk reduction. Generally, the following action steps may be considered. Reduce the volatility of cash flows. Fixing interest rates on loans provides greater predictability in terms of financing costs. Cost containment. Taking control of your payment terms. Implementing stringent billing and credit control procedures. Saying goodbye to customers who consistently violate your credit terms. Commodity price exposure, or your susceptibility to changes in the price of raw materials. For example, if you work in the haulage industry, a rise in oil prices can result in increased costs and decreased profits. Assuring that the appropriate people are assigned to the appropriate jobs with the appropriate level of supervision in order to minimize the risk of fraud. Conducting due diligence on projects, for example, by taking into account the risks inherent in a partnership or joint venture. Who is responsible for financial risk management? Risk management is the responsibility of the business owner and senior management in a small business. It is only when the business expands to include multiple departments and activities that you may wish to hire a dedicated financial risk manager to manage risk on the company's behalf, and to make recommendations for action. For hiring a consultant CFO to take care of your financial risk management plans at a very affordable price, please contact Meraki Business Consultancy Limited, call 050-786-9106, or email TARIQ@merakibcl.com.